what I mean. I'm
Hey,
had perfect vision my whole life. Hi.
hey, hey. Wel-
Hello.
Welcome to the Real Life Podcast where we talk real estate and
Life insurance. Hello, y'all.
hey, y'all. In case y'all don't know who I am, you can see my name right there on the screen. I'm Shanita Johnson, licensed real estate broker in Tennessee and Mississippi.
And I am Ariyan Johnson, a licensed financial professional, specifically with life and health in Maryland, New Jersey, and Tennessee.
And
Yes. What are we
today,
talking about this week?
yes, so today we're talking about on the real estate side, and I need to close some closes because no, it's getting too crowded. So today we were talking about on the real estate side is something that I often hear people when they call, they're looking for this specific type of property, and it is a lease purchase option. Oftentimes when they're looking for this type of property, they are doing so because either they don't have a down payment saved or they have credit challenges. So today I'm going to break down what exactly a lease purchase is and the pros and the cons of it. So without further ado, so basically what a lease purchase, and y'all know me and this glare, not gonna get along on these glasses. So basically what a lease purchase option is, it's kind of in the middle between renting a property and buying a property, where you have a deposit. So when you're renting, you have a security deposit, and when you're buying, you have a down payment. So when you're doing a lease purchase, you have what's called the upfront fee. The upfront fee can be 1 to 5% of the purchase price of the home, right? Depending on the home price, that so it can be significantly more than what you would pay if you were just renting a property and having to pay a security deposit. All right, the second thing that you need to know about a lease purchase option is your monthly rent. Depending on the seller of the property, or yeah, depending on the seller of the property, a portion of your rent may go towards the purchase price of the home. For example, if your rent for while you're in this lease term is $1,500, let's just say it's $1,500, and the seller has the option to apply maybe $100 of that of your rent payment towards the purchase price of the home. Now, not all sellers do this. I have found some that they don't do it. Your rent is your rent, and you save money however you need to save it. The purpose of them keeping a portion of the putting aside a portion of the your monthly rent payment is to help you with your down payment when you eventually purchase the property, and it kind of forces you to save the money, right? The third thing
So
that you
is
need to
it something is that something that is pre-agreed upon before you sign your renters lease?
absolutely, so
Is it
that's
the
the
amount as well?
yes, so everything, so it's when you enter a lease purchase option, you sign basically a lease agreement. And in that lease agreement, it has all the terms. It has the purchase price of the property. It has the terms that you're going to rent the property for, whether it be from 12 months to 36 months. So it can be 1 to 3 years. It'll have your rent amount, your monthly rent amount. If a portion of your rent is going to go towards the purchase price, how much of it, if it is going to go. It'll have the amount of your upfront fee, like I said, the 1 to 5% of the upfront fee, which is essentially your security deposit or your down payment. And it'll also have any other things specifically in that lease that that you would need to know. So it will say something like you're responsible for all the maintenance. So it kind of puts you in the owner mindset while you're renting this property, Um, but maybe not all of the maintenance is on you. So maybe you'll be responsible if there's a plumbing issue. But if the you know if a tree falls on the house and puts a hole in the roof, maybe the seller will cover that. But all of the terms of what you'll be responsible for will be in that lease agreement. So again, it's still a lease agreement and it has all of those things. The only difference is that the seller is agreeing to sell you this home at the end of your lease term, whether it be 1 to 3 years, at this price. So that means if the values of homes in the area where you're living, if the values go up, let's say the house is valued when you do your lease purchase, let's say the house is valued at $200,000. And then at the end of your lease term, the house is valued at 235. If your lease agreement says you can purchase this home for $200,000, well, that gives you $35,000 in equity, right? So that could be a benefit of a lease purchase program. Where it can be um, not such a good thing is, well, let me go back to the pros. So the pros again, you're paying rent. You're living in a neighborhood that you want to live in. You're paying the rent. A portion of your rent is going toward the purchase price of the property. You're getting the feel of the neighborhood of where the property is. And then you also still have that flexibility. If you don't want to stay there, then you don't have to stay there at the end of the term, depending on what your lease says. And then the the cons would be if if the seller says no, your rent is just going to be your rent, and then you don't, you know, you're just renting, and they have that upfront fee. Um, if another pro would be it gives you time to save money while you're previewing this neighborhood, and it also gives you time to build your credit. Now, this is a good thing and could be a negative thing because if you're just living there and not doing the things to strengthen your credit so that you can become mortgage ready, then you're defeating the purpose of the lease option program. So it can be beneficial if you don't if you need some time to build your credit, if you need some time to save money. But from my perspective, and I'll give you just 1 second. From my perspective, if you're paying a percentage, if you're paying a down payment, if you have enough, if you have enough money to pay 5% down on whatever this, 5% down of the purchase price, you may as well buy a home. That's my personal opinion. But again, I understand why someone would want to go that lease purchase option if they're not sure. So, what questions do you have?
So for the upfront fee,
Yeah.
say for instance, at the end of my term, I don't want to buy the house. Do I get that refunded or is that just a wash?
So it depends. That's something else that can be in your lease that that can be negotiable depending on the seller. If you're in the option to buy a lease with an option to buy, meaning your lease says at the end of this term, you have to buy this, you have to be ready to buy this house. If you don't buy this house, then you lose your money. That's definitely can happen because you have to think about it from the seller's point of view. They let you stay in this house for 3 years. Let's go with the max. They let you stay in this house for 3 years, paying this amount of rent. They held this money, and they're agreeing to sell this house at this price because you need time. And then at the end of the term, you say, I don't want to buy it. Well, they could have sold the house 3 years ago and got the money and been done with it. But instead, they essentially wasted time waiting for you to get ready and you changed your mind. So it's kind of a penalty if you don't follow through because it is a legal agreement. So, yeah. It just depends on how the lease is set up from the beginning.
What are some of the other cons to a lease purchase?
So, like I said, the way I see it when it comes to um with the upfront cost, the large deposit that you have to make. Um, because let's just say again, we're gonna use a $200,000 house, and let's say your upfront fee is 5%. What is 5% of 200,000? I don't know. Let me get a calculator. That's $10,000.
What do you do say five? I can do math sometimes.
So if the house is $200,000, the funding fee is $10,000. That's a down payment.
Yeah, that's how much I think all of my closing costs were just over $10,000. So yeah, that's a
But on
lot
the
up
other,
front.
it is. But on the other hand, if it's 1%, then that's $2,000. So it
And
just
then also
depends.
you also have to consider if you are going into an agreement with a seller who does not take a portion of your rent
Exactly.
towards the cost, then you
Right.
end up wasting a lot of money just paying rent and it's not really going anywhere.
Right.
Um,
So you're still just
so
renting, and that's what
yeah, I
the
can
when
see that kind of being,
I'm sorry, go ahead.
I, now I was gonna say I can see that as being beneficial for its reasons, but it does come with a hefty cost. It has to be some like if it's giving you the time to be sure, you have to be sure before you're sure,
Right.
pretty much. Because if
Because
not, then
otherwise,
you end up spending a lot of money for, and
and you
you would end up spending more money had you not, or you would spend less money if you just went to a regular renter lease agreement because
yeah,
of the upfront costs.
yeah. And then um something else I didn't mention, the rent is not going to be market rent either. It's typically higher than market rent. So if especially if they're holding a portion of it for your down payment or toward going towards the purchase price of the house.
So about how much higher? Because I don't know the current average right now. Last I heard it
Mhm.
was about $2,000 a month. Um, but I don't know how
So
much average rent is right now. So if it's
mhm.
more than that, how much more are we looking at? Like,
So the average is going to depend on the market, but
right.
I will give you a specific example of a home that is lease purchase that's near me. It is, the house is, I want to say it's 4 bedrooms, 4 or 5 bedroom house. The rent, the lease purchase rent is $4,500.
Oof, oof.
4,500. And the purchase price of the house, let me see if I can remember the purchase price. I don't remember the purchase price, and I'm not going to look at it. But the rent is $4,500.
That's a lot of $100.
It is. And you think about, again, you paying this upfront cost of, I think in their case, their upfront is 2 months rent. So you're paying $9,000 upfront, and then you're paying $4,500 a month.
If you said that average is like the average upfront cost roughly about 5%, is that the average amount?
It depends. It depends. It depends on the price point of the house because there's a community that's in Fayette County here. The houses are all of the houses are right at $200,000. They're newly built homes. Most of them are for sale, but the builders they are given the option to buy on a lease purchase. Their down payment is I think theirs is 3 months the rent, and the rent is like $1,700. And but they don't hold a portion of the rent. You don't get to apply a portion of your rent towards the down payment. You're just paying rent for it, and they only do a year. So they give you a year to get your credit together so you can actually buy the house. but they're not taking a portion of your rent payment and applying it to the purchase price. You're just losing that $1,800 a month or $1,795 or what it is. So,
That's costly. Very
yeah.
costly insuredness.
Mm-hmm.
Yeah,
And
that's
I
a lot of money.
understand. Yeah, because the misconception is when people hear rent to own or lease with the option to buy, I think they equate it to all, like when you go to and I'm looking out the window over here because there's a furniture rental place next to my office. And I think that's the mentality that some people have. You know, you pay the rent to own furniture place, you pay them what, $50 a week, and you pay it for like three
Mhm.
years, right? But at the end of that 3 years, you own it. You're gonna pay three times what it costs to buy it, but you're gonna own it at the end. So I think, and that's not the same. That's not the same way it works in real estate.
Right.
It's not like all of your rent is not going to buy the house. It just doesn't work like that. So yeah, I had to clear that up for her. And so when I said that to her, she said, "Well, I may as well keep renting." And I said, "Well, that's your choice. That's your choice if you want to, and I told her, I said, if you want to, work with a lender to get you to the place where you can purchase a home, that would be a good idea because with the lease purchase, you're still leasing. So that's it.
That does give me an idea for a topic we might have to touch on a different episode. I will just put the bug in your ear though. She said that I might as well just keep renting, and I saw a video on Instagram or TikTok, one of them, and a girl basically mentioned that there's no point to buying a house because even after you pay off your mortgage, you still have to pay property tax. You'll never own your you'll own your home, but you still have to pay the government. You still have to pay for property taxes. And the guy stitched the video and he was like, yeah, you always have two landlords. The first is your bank, and the second is the government, and you'll always have the government. And I do want to touch on that. Like, I do want to talk about that in depth in a separate episode, but I do think that's an interesting concept, especially when people are thinking about things like a lease purchase or rent to own. If like think like basically dancing with the idea of potentially buying a home, but they're comfortable in renting right now.
And it's always going to be what your based on their financial situation, right? So you we real estate is specific. You have to, just like it's specific to a city, it's specific to a county, it's specific to a state. It's specific to your financial picture. Just because someone your same age making the same amount of money that you make doesn't mean that both of you are in a position to buy a home. You just have to look at your financial picture, look at your current situation, look at your future goals and see if that's what you want to do.
Right.
So, I mean, it's all subjective.
So
Yeah, yeah. So,
that's some good topics there
yeah,
to think about. Please get in contact if you are interested in that kind of thing or have more questions on it. But
yeah,
today, I want to talk about also reviewing your options in a different field, specifically with life insurance. There are multiple different kinds of life insurance. I think most people only know what term and whole, and they're
right.
like, that's all there really is. I'm going to talk about both of those and then a couple other options for you. Um, and a little bit about why you would get different ones because the type of life insurance you get, one, first off, it's not cookie cutter. Everybody is not meant to have the same type of life insurance policy. Everybody's not meant to have the same amounts. Like, a term life policy might be right for Sally Sue, but Billy Bob, he might need a whole life. Like, it depends on your situation, just like when it comes to buying a house. It's going to depend on your situation, what your goals are, and your medical history. It's going to depend on your age, what your family situation looking like if you're married and have children. All of these things are variables, and it depends on what you need. So get that part out of your head. Just because someone says, hey, don't get this life insurance, get this one. It may not be the best idea for you because of your situation. So I'm gonna go over a couple of them. So you have two main categories. You have term and you have permanent. There are multiple different kinds of permanent ones, but those are your main two. You have a term life policy and you have permanent life policies. Term life is short term, it is temporary. It is the cheaper option and it's for a certain period of time. Most insurance companies are in between the years of like 10 and 30-year terms. However, it varies from insurance company to insurance company. Some offer less years, some offer more. Typically within like the 5 and 10. What's the word I'm looking for? It's escaping me. Anyway, it's in within that range. And it is the cheaper option. Now, term life is a great option for people who want life insurance, but they cannot typically afford a more expensive policy, and which is also great for people who have children. Um, and say, for instance, you have two children, they are 4 and let's say 2, but you still want to have more children, but let's say you have those two. It'd be great to get a term life policy to cover your life while they're growing up and while you're still raising them. And the best, you want to make sure you get enough a long-term policy that will cover until they're in between the ages of 18 to 21. So somewhere about that. So if you have a 4 and a 2-year-old, and let's say you don't want any more children, a 20-year policy will be fine because by that time the 4-year-old will be 24, the 2-year-old will be 22. You've covered their entire lives while they're children. So basically, if anything happens to you while they're growing up, they will be financially okay. However, let's say you do want more children or you're considering having more children, it'd be best to consider getting a longer term period so that you can account for any extra children. So instead of just getting a 20-year policy and you want more children, get a 25 or 30-year policy. That way you can account for any other children you might have after the 4 and 2-year-old. You have a little bit more room for growth. That way, if you have more children and you only got the 20-year policy, then you either have to get a new policy. You would have to basically have to get a new policy, either cancel the old one and get a new one, or just get an additional one to cover the newer children. So consider that when you are thinking about your term. Another good reason people get term life is for mortgage protection. If you just buy your house, I know we talked about this in our first episode about mortgage protection. Term life insurance is a great idea for that. It's great to have in addition to your regular insurance. That way your house is always covered, no matter what. So if you want more details about that, you can go ahead and listen to our first podcast episode because I talk about mortgage protection in depth, um, and all the different options there. But that's another general reason people get term life. So like I said, it's cheaper. It's for your short-term needs. Short-term needs. Um, there are some people out there, specifically in I was going to say his name, but it's a finance podcast host that a lot of people know. I'm not going to say his name, but he is very much, he preaches the idea of buy term, invest the difference. That is a very antiquated um, philosophy that people still use to this day, where they will buy term life insurance for how many years, and then the extra money that they would have spent on a whole life or a permanent life policy, they'll use that money and invest it in the market. Um, Now, that might be great for some people, but like I said, not everything is for everybody because you may not know what to invest your money in, where to invest your money, and you might have make some bad investments. And another issue is it does not diversify your money as much because, again, not everybody knows how to do that. But like I said, it could be an option for some people, just not for everybody. Permanent life insurance lasts until it lasts your whole life or until 121. It does stop at 100. It does stop at a point. 121 is the longest it'll go, but not very many
But what
people
if,
are living until 121.
so if I live to 121?
If you live to 121, you're covered. 122, I don't know what to tell you. But all permanent life policies, if you look at your illustrations or your policies, it stops at 121. um, but permanent life policies, they are a bit more expensive, but that is for two reasons. One, that is the insurance company financially protecting itself because it you are guaranteed to go get paid if your family or your beneficiaries are guaranteed going to get paid. They have to make a payout no matter what because it's covering your entire life. Whereas with term insurance, there's a high possibility they're not going to have to pay out. In fact, only about 2% of term life policies pay out. Only two, about 2%, because
That's
most people are
interesting.
outliving them. Yeah,
Yeah.
most people are outliving their term policies because most people get what, 10, 20, sometimes 30 years. I actually had a client who had a term life policy, and the client told me because they had it for a family member, and the family member was like, "Wow, I didn't think he was gonna make it this long," and he outlived his policy. So yes, also consider that.
That's interesting.
Yeah, and you don't get that money back either. Um, but permanent life, they have to pay forever. That's one of the reasons why it's more expensive. The second reason is something called a cash value component or a cash value benefit. It's called different things depending on the company, but cash value component or benefit is the main name for it. And that money is money that is set aside, and you can use it's your living benefits. You can use that for whatever you need. Medical emergencies, life emergencies. Sometimes people use it to make big purchases like buying cars, mortgage, college tuition, and retirement. It's used for all kinds of things. There are different ways to access it. I don't have enough time to explain all the different ways to access it, but you can access it with our favorite two words, tax free. We love those words. You have tax free access to it, it is your money.
Yeah.
Um, but permanent life policies always have that. That's how those are the two determining factors of a term life policy. Permanent life. It lasts forever and it has that cash value. Now, there are multiple kinds of permanent life policies. The most common is a whole life. Most people know what a whole life policy is. That one covers you for your entire life, has the cash value. Now, what is a factor of this is how that money grows within your cash value. It grows at a fixed rate. Depending on the insurance company, you may also receive, in addition to the interest that grows, you may also receive dividends for that company. It just depends on the type of insurance company. If it's like a mutual profit sharing insurance company, then you might receive dividends with that one as well. But it depends. Not all insurance companies give dividends with to their clients. Um, but the interest rate, it grows at a steady rate. Consistently, you'll pay the same amount every single month or every single year, depending on your policy. It'll grow at a consistent rate. Your death benefit is not adjustable. It is what it is. And your premiums will always stay the same. Premiums will stay the same. Your interest rate will be the same for your growth with your cash value. And your death benefit is always going to stay the same, no matter what. And then you have what seems to be coming into popularity a little bit more are IULs, even though they've been around since the 70s, if I'm not mistaken. IUL is an index universal life. There's also a VUL, which is a variable universal life. Um, and I'll talk about the difference between the two of those. But basically, those are basically whole life on steroids because there are higher chances of growth with those because those your money is either directly invested in or tied to the growth of the stock market. The VUL or the variable universal life, that money is directly invested into the stock market. So if it goes up, we all happy. We all making money. If it goes down, then you lose money. We not so happy no more. Those you have to have a securities license to sell those. So make sure that whoever your broker is actually has that license. You don't want nobody committing fraud on you. Make sure they know what they're talking about. You also want to make sure you have an experienced one. So to make sure that your money is going to the right place because you can't control where your money is invested. Um,
Can.
yes, you can.
Okay.
You can choose what market your money goes to. Um, so you have that option, you have the freedom. Just make sure you're talking to somebody who one knows what they're talking about and answers all your questions and shows you your options. Index universal life, the money is not directly invested into. However, it is tied to the growth of the stock market. So when it comes to indexing, I think I talked about this one in the last episode a little bit. But indexing basically, as the market grows, you grow with it up to a certain extent, up to a certain point. But if it drops, you are protected because you have a floor. You have downside protection no matter what. Um, and with this one, you can also choose which market your money is tied to. You can choose whatever market you want, depending on what markets that insurance company provides. Um, Also, with these universal life policies, your premiums are flexible. You can pay varying amounts up to a certain point without getting taxed. Um, and your death benefit is also adjustable. So you have a little with the universal life policies, as opposed to a whole life policies, you have more freedom and a little bit more flexibility than a whole life policy. Um, you have a little bit more freedom to choose when you pay because you can do monthly, you can do quarterly, you can do semi-quarterly, and you can do annually. It You have a little bit more freedom. You have a bit more freedom on how much you want to pay. There is a minimum just to keep the account open. There's a target to if you want your financial goals to be achieved, you pay with that target. And there is a max that you can pay without being taxed. If you pay above that point, then you will be taxed on that money. We don't like that. We don't like being extra taxed. Um, huh?
That's a lot.
Yes, we don't like being taxed. But basically, universal lives policies, more freedom, more flexibility. You have more options, which is why you also want to make sure you have somebody who is very clear with you and explains all of your options when it comes to those things. Um, another life insurance policy that almost knocked my camera off. Another life insurance policy that people do not consider is also another type of permanent life policy. It's final expense. This is a whole life policy. Now, the difference between final expense and whole life is that the max amount is a lot lower. Final expense is exactly what it sounds like. It is for those final expenses once you pass away. Final expense life insurance is more targeted towards senior citizens because a lot of the cutoff ages for a lot of other term policies are a lot lower and they're not eligible for those. Um, but final expense, I think the most that I have seen it is about $50,000. Um, but it varies. And I think the minimum is about 5 to $10,000. It would depend on the insurance company, but I think it's 10. Um, but final expense is a type of whole life policy, is basically a whole life policy. It can be pretty expensive. And it does also have age cutoff limits. I think the highest I've seen is 80. But most of them are about 75. But final expense is a type of permanent life policy that will help you if you are a senior citizen and you don't have any other options, but you still want to have some kind of coverage um, for when you pass so your family's not scrambling for money because the cost of this sounds morbid, but the cost to die is expensive. It is really, really expensive. Funeral costs are about last I checked, according to the National Funeral website, the director's website. It's about $6,000 to $8,000 for funerals and
So,
burials. Cremations are also about 6,000.
so you
Go ahead.
said the max age is 75.
The highest I've seen for final expense is 75. No, the highest I've seen period is 80, but most of them that I've seen is 75.
Interesting because when you have people who have retired and the only life insurance they had was through their job and they didn't consider getting any other life insurance while they were employed, and they start to get ill and here they are with no insurance, and by the time they think about it they're 75, or by the time their family thinks about it they're 75, and they're just living off of their social security or their retirement pension or whatever, and yeah, it may not be enough to take care of that. So that's very sobering, to say the least.
Yeah, this
Mhm.
is why I've been talking to people my age. Think about it now while you
Mhm.
can. And you mentioned being ill and unable physically,
Yeah.
with our older family members. We were talking about getting life insurance for your parents, my grandparents.
Yeah. Yeah.
And it's difficult in that case because Granny aged out.
Yes.
Um, and Granny is 80, should be
One.
82 this year.
Yeah.
She aged out.
Yeah.
We did manage to find one. I just remembered we did find one that was she was about it was 85. But the cost of it was a
Yeah.
hundred and some odd dollars a month. It would have
Yeah.
made more sense for her to just save money
Just
instead.
save it. Yeah.
And then my grandfather, your dad, he just missed one of them,
Hmm.
that we were looking at, that he missed out on the cheaper option. And we did find one, but again, it was just way too expensive.
And
Um,
and he falls in that category. So he has insurance through his job that he's still working at 76.
yeah.
Um, but the time will soon come when he's not able to work and he doesn't have the insurance, and trying to get him to a place where he needs to save and put the money aside. That's a whole different thing. Yeah.
And I also wanna mention, um, because I talk to a lot of people and they say they have insurance through their job, because you've mentioned it twice now. I was recently going through some paperwork and I used to work at Starbucks. Starbucks does provide life insurance. Um, but I saw how much that my beneficiaries would receive. Obviously, the amount is going to vary from job to job, from business to business, and what type of job you have. Obviously, blue collar jobs might have a little bit more than white collar jobs, pink collar, all that. But mine was only $5,000. It was $5,000, and a lot of these life insurance policies only apply if you pass away at work. Well, you also need to look at that. But for mine, it was $5,000, and I just said that the average cost for funerals about $6,000 to $8,000, and that's not to mention probate court, your probate fees. You have to also pay for those, and those can be pretty expensive depending on the size of your estate. If it's a smaller estate, it could be a couple $100, but if it's a really large one, or if you got money in you got things all scattered everywhere, it can be well into the thousands. And it also
And,
takes years for that.
and yeah, and so that's my lane where I talk about avoiding probate at all costs, because it will eat up your estate if you don't set yourself up properly, because you're essentially making the state your beneficiary if you do not have your affairs in order. We're not talking about that today.
No, no. Talk to estate attorneys.
Please
Um,
do, please.
but yes, back on track. Final expense. That's what that is for. It is an option.
Yeah.
Um, so those are your basic. You have term and permanent. For your permanent,
Mhm.
you have whole, you have universal life, index universal life, variable universal life, and you have final expense. Um, and the very last thing I want to mention very quickly is children's. life insurance. Children can get whole life policies. They auto for children. If you get life insurance for a child, it is automatically a whole life policy. Um, they do offer JLULs, which is a junior index universal life. But for like if you recently had a baby and you get an email, not an email, mail from Gerber Life, that's them offering you life insurance. You can get them as soon as your child has a social security card, you can get them life insurance, no matter how old they are. And it can be pennies on the dollar every single month. It's extremely cheap and and you can increase it at any point. The lowest I've seen about is $5,000 for about $30 a year. $30 a year. And it is always best to get children life insurance while they're children, not just because it's cheap, but it guarantees insurability. Because anything, when I say anything, anything can make you uninsurable. If you happen to get in a car accident and you are paralyzed, you become uninsurable. If you have cancer, it doesn't automatically make you uninsurable. Some cancers do, but there's a time frame that you have to wait. Like I had a client who had cancer, and the one of the insurance companies that we were looking at, they had to have been cancer free for about 5 years. Sometimes I've seen 10 years. Um, Certain heart issues, lung and liver issues, people who work in fields that'll have like the hot hazards of the job, those kind of things, where they're breathing in certain fumes or they're in constant contact with certain things. A lot of those can impact their health and make them uninsurable. So there's a lot of things that can happen. So I highly recommend as soon as your child is born, go ahead and they get a social security card, get them life insurance. It is extremely cheap. If you don't have it for your child now and your child is still really young, like I did a policy for a 9-year old and it was $36 a year for a $5,000 policy. And the best thing about it is that amount, it will stay that $36 a year for the rest of her life. Unless they raise it to like 10,000, 20, whatever, it will stay
Yeah.
that amount for the rest of her life. So highly recommend doing that. Those are your options. There are many options out there, like I said. Not everything is going to be for everybody. It depends on what's best for you. And if you would like to know what's best for you, hit me up. Even though I only serve in the three states, I also consult and advise. Um, all of our information will be at the end card, but feel free to email me. We can talk about what's best for you. And mother, if you need to know some more about these lease purchases or you are considering buying your own home, contact her. She has hands in every state. She got on me last time for not mentioning that, but she got hands in every state. Um, please
50
contact her.
states. And
Yes.
recently, well, maybe not too recently, but um I have a lender that lends money nationwide too. So
Oh, look at that.
if you're looking to buy in Central America, South America, Africa, Europe, Asia, your sister wants to when she saw Thailand, she said, "Oh, I'm going to Thailand." So, yeah, if you're
Yeah,
looking
we
to
talked about it.
leave the United States and you need funding, I can connect you. I can be the plug.
See there? See there?
Thank y'all
We
so
got
much
it.
for doing this.
Yes, thank you so much. We enjoyed this time. We will see y'all
Next
next
time
week with some
on
more. See you
Real
guys
Life.
every day.
Peace.
All right, y'all. After hearing some of those pros and cons to a lease purchase option, do you think that is something that'll work out for you, or do you think you might go another route when it comes to buying your first home? And then about all those different options for life insurance, did you know that there are so many different things and many different options can be for many different kinds of people? Which one sounds like the best one that works out for you? Don't worry if you don't know. For either of those things, we are always here to help. Feel free to connect with us. With my mom for all things real estate, you can find her at the Shanita Johnson. That is the Shanita Johnson on Instagram, Facebook, and on YouTube. Or you can email her with the subject of real life to Shanita at ShanitaJohnson.com. Again, that is Shanita. Or you can contact me for all things life insurance. You can connect with me on Instagram at rj.john, on TikTok, ari.j.john, or on YouTube, Future Planning with Ari, or you can email me with the subject of real life to ariyanjjohnson at gmail.com. That is ARIYANJjohnson at gmail.com. Thank you so much for tuning in with us today, and we will catch you guys next week.